Hey, hi everyone. Welcome to another video in our hedge fund strategy series. So today we will discuss about contra trading. So this is also one of the strategy deployed by hedge funds. Previously we discussed about global macro strategy. So this is contra trading. So contra trading is buying assets that are out of favor or oversold and selling those that are overhyped or overbought. So that is the core idea in behind contract trading. And the goal is to exploit mispricing caused by herd behavior or emotional trading. And we can use different tools like sentiment indicators, volume analysis, RSI below 13, volatility spikes, and fundamental undervaluation. So these tools could be used to identify trades for contract trading. And psychology often, this trading will be opposite to media headlines, investor mood, and analyst consensus. So the famous quote by Warren Buffett, if you see, what it says is, be fearful when others are greedy. So when the market is greedy, it is like overbought, you be fearful, you sell your stocks basically. And greedy when others are fearful. When market is, totally fearful and they are selling, you try to buy. So that is the main motto behind the contra trading. And this is a famous quote from Warren Buffett. So yeah, so coming to hedge funds, so this is one of the strategy used by hedge funds, the contra trading. So basically buying the assets when they are oversold, and selling the assets when they are overbought. That is what is the strategy. And yeah, the hedge funds which excelled doing this contra trading are, and traders in those hedge funds who excelled doing this contra trading are Michael Burry. He is from Square Capital. So he shorted the subprime mortgage market before the 2008 crash. So subprime mortgage market is in US. They used to give loans to buy houses to anyone and everyone without checking the background, and without checking the financial capability to pay back. And banks did that based on political promises done by certain um, parties. But yeah, this Michael Burry has from Scan Capital, when everyone was buying basically the subprime mortgage market, that it will go up and up. The real estate prices will go up and up only. This guy found that, the loans are being given to people who don't deserve or who can't pay back, and they are defaulting. So he shorted the subprime mortgage market before the 2008 crash. It crashed in 2008. Lehman Brothers was the major fallout out of that crash. It totally went bankrupt, and many companies were also bankrupt, like AIG and a lot of other companies. Even GE was bankrupt at that time, and government came to save those companies. But he identified that this will crash before, and he shorted that market before the 2008 crash. Okay. And he made around $700 million for his fund and himself, and he's featured in the Big Short movie. So Contra move is very, when everyone was bullish on housing, he bet against these securities. So it's very, it will take you on an emotional roller coaster ride, and only when your conviction is very high and you have data backing your conviction, then only doing such sort of trading will give you a lot of money. And in the hedge funds, it is done in a very large scale, like millions of dollars uh, trading is done. So yeah, this is a famous example of Michael Burry from Scan Capital shorting the subprime market mortgage market before 2008 crash, and making 700 million for his fund and himself. And he's featured in the Big Short movie. Then we have Seth Klarman of Baupost Group. He is known for deep value investing and contrarian investing. So he avoids crowded trades. So if everyone is buying, he avoids it. He often buys distressed or unloved companies. So again, distressed companies, but they're undervalued. Okay, so fundamentals are all strong, but they're undervalued due to some reasons. And he invested in undervalued. So after 2008 crisis, Most of the companies were trading at very low prices, in the stock market because of the fear that is prevalent in the market. And he bought during that time. He bought the distressed assets during that time, and made over 30 a lot of money during post 2008 financials. His fund size is 30 billion assets under management. Then we have David Tepper. So Tepper Business School of Carnegie Mellon is named after him. So he was managing Appaloosa Management. So this is the fund he used to manage. His main strategy is buying distressed bank stocks after 2008 crisis in 2009, when bank stocks, like all the bank stocks were trading very cheap. He bought those distressed bank stocks when fear was at its peak. He bought them. Okay. And the belief was, the contrarian belief was, market has overreacted and government would stop this and come to help the companies. And yeah, he made good profit when the market rebounded after 2009. He made a good profit of 7 billion gain. George Soros is also very famous for contra trading. He betted against the British pound on the event called as Black Wednesday, and the belief was the UK couldn't maintain its currency peg, and he profited 1 billion in a single trade. Uh, okay, and Howard Marks from Oak Tree Capital is also focuses on distressed debt and cyclical opportunities. Often buys in sectors others are dumping, like real estate. He buys during downturns, so at very cheap prices he will buy the real estate when the fear is there in the market, and then when the market again comes back, he will sell them at a very premium price. So that is what the strategy of distressed debt and cyclical opportunities. Some very good examples of contra trades are, during dot-com crash, many people bought undervalued businesses or legacy businesses like energy and industrials, and they gained 2 to 3x returns. COVID crash also, during COVID crash is a classic example. During COVID crash, the markets went down a lot, and like people bought travel, airline, and hotel stocks, expecting that this will end after a few years, and they made 100x returns in many investments. Tech overhype also. This is shorting. So if there are some tech companies which are overvalued, then you short those tech stocks, and you make money in it. Commodities crash also. Okay, so or if the oil stocks or mining stocks are very down, then you buy those at a less value, and you get a lot of money in following 2 years. The only disadvantage of counter trading is if you are early, it can be very costly. You should be entering at a right place, and you should have a lot of conviction because you're going against momentum and against what's happening. So if your conviction and research and data, it you need to have a um, emotion. You will go be on an emotional roller coaster if you do this. Okay, and you need to have nerves of steel to go through this, and totally you need to be emotionless, and purely depend on conviction and data to do such sort of contract trading. uh, So yeah, those are the risks. So other people who are very famous. So this Japanese bedroom trader, he's called Takashi Katagowa, and he's also called BNF, Buy and Never Fail Guy. So he's finance. He's not from a finance background. He's just a retail trader. He's not a hedge fund guy. Also, he saved some $13,000 by doing odd jobs, and he used to look at charts for 2 years, and he got good knowledge in the Japanese market, and he's known for turning this $13,000 into 150 million in within his late 20s. His style is extremely contrarian in short-term trading during volatile Japanese markets. So whenever there is a panic selling, he used to exploit the panic selling, whichever stocks were oversold due to news-driven crashes, and he used to rely on technical levels and instincts, no fundamental analysis he used to do. The stock falls, 15 to 20% below 25 moving average. He used to select those stocks, and he used to see the valuations, the fundamental means whether those companies are good to will recover or not. And if he sees an opportunity that they'll recover, he used to buy those. So example is when the liver door scandal crashed the Japanese market, he bought it during extreme panic, and he profited millions in just days from the snapback rally. And no leverage he used is contrary trading only is his style. No margin, complete market psychology, no news. He would be totally away. Was able to control his emotions and be extremely disciplined, and uh, also not get swayed by the news. But even though he made millions of dollars, he used to live a frugal life, live in a small apartment, and he avoided publicity and rarely gave interviews. We have another guy, Ken Griffin from Citadel. He's from Harvard Business School. He manages. He's the owner of Citadel, which is a very big hedge fund in the world. Um, yeah, so Citadel also used this quantitative trading in a few of the cases. Like during the 2008 crisis, Citadel aggressively bought distressed assets that others were dumping, especially in credit and equities. And this went against some prevailing panic, and he made a lot of money when the market recovered during the 2000 after the 2008 crisis. Another thing he did is also like Citadel does is it bets on regulatory decisions, earning surprises or restructuring. Sometimes against this consensus also, and event-driven arbitrage they use, and they use contrary event-driven arbitrage. And these are the events they use: regulatory decisions, earning surprises, and restructuring to do contra trading. A famous example is GameStop short squeeze. So GameStop was trading at $2, and all the hedge funds shorted it that it would go to zero. And suddenly, the retailers, based on an article, started buying it, and the hedge funds were in a loss actually. And in game short, actually, Citadel was involved in market making. So market making is you are basically allowing the buyers and the sellers to be able to participate in the market. So you gain money through the bid ask spread. Okay, so that is what is your money making thing. So it Citadel does that market making also, but it saw a distortion in the market during this time. GameStop short squeeze, and yeah, this was not on the from the buyer side. Like during the short squeeze, the buyers basically bought this, and the price skyrocketed, and hedge funds were in loss. Most of the hedge funds were in loss, but Citadel was doing market making and catering to both buyers and sellers and making money. It also stopped that Robinhood app where retailers were. It didn't stop it, but yeah, Robinhood app was stopped for a few days, and retailers were not able to trade. In the meanwhile, the price got stabilized, and yeah, Citadel was able to make good money from this GameStop short squeeze also. Yeah, the main thing Citadel used in contrary style trading is this one. Citadel bought the distressed assets during the 2008 crisis, and people were dumping that during that time, the credit and equities, and it went against panic and made good money from this. So this is one of the very another strategy used by hedge funds. So if you see Takashi Kotagawa, BNF, intraday guy, retailer, panic bonuses, pure contrarian, bought everyone was selling, 150 million in personal fortune. Does a lot of other things also. These are only few examples where they use this strategy. Opportunistic contrarian thing they used during the 2008 crisis. They have a very lot of big fund. It's a very big fund, 16 billion. Okay, we will have a video on Citadel separately, but I just wanted to cover this contra style hedge fund trading. This is another hedge fund strategy. So that's it for today, guys. Thanks. Have a nice day. Bye.